Welcome back to another episode of the Weekly Ticker. If you're new here, every week I go over a stock and decide whether it's a buy, sell, or hold. This episode we're going over OnCloud Holdings under ticker ONON. I'm sure many of you know them by their shoes, but if you don't, they're a apparel and footwear company operating out of Switzerland. They gained a lot of traction from their comfortable and fashionable shoes. I made a video about a month ago comparing OnCloud Holdings with Nike, and since then the stock has really picked up some traction. Over the past month, it is up 16.28%. I'm going to tell you whether it's still worth buying, so let's jump right into the analysis. Analysts and firms have been buying this stock left and right. Currently, the stock price right now is at $48.18. Many analysts are forecasting a one-year price target of $61.70, which is a 28.05% price increase over the next year. So in terms of their financial health, they actually look really healthy. In 2024, their debt was around $442.04 million, and their free cash flow and cash and equivalents could completely cover this debt if needed. Low debt is always a good thing, although OnCloud has taken on a little bit more debt, and I'll jump into that when I look over the financial statements. So their total revenue has increased by a decent amount. In 2020, they were sitting at $453.11 million in total revenue, and then trailing 12 months, they're now at $3.40 billion, a huge increase. And every year, we've seen a percentage increase year over year, a very strong number. 74% was that peak in 2021. It's come down a little bit more as the company starts to mature, but still shows signs of extreme growth compared to Nike, which is showing around a 5% year-over-year revenue growth. Most of their income does come from wholesale partners such as Dick's Sporting Goods or Foot Locker. When Nike was taking their products off the shelves, OnCloud really stood out to the consumer, and they gathered a lot of considerable traction from the American consumer, as these Nike shoes, the top apparel and footwear brand in sports, wasn't there anymore. So OnCloud kind of filled the shelves, and they gained a lot of traction for that. Most of the revenue does come from the US, although they do have some revenue coming from Europe. As of 2024, 1.55 billion of their revenue comes from the US. So the US is this big driving factor in their total revenue. So their total revenue is increasing, so is their gross profit. Really, their cost of goods is quite low. Most apparel and footwear companies do have a low cost of sales, but in terms of OnCloud Holdings, it's lower than the average, and their gross profit is super strong. Year over year, trailing 12 months, they are up 42.74% for their gross profit. Now, their net income has been a little spotty. You can see in 2021, they actually had a negative net income. I'll show from their free cash flow that they were kind of reorganizing the company a little bit more. But since then, their net income has grown. Trailing 12 months, they are lagging a little bit in net income, which could be due to a couple factors. But yeah, they are down 3.96%. So their diluted earnings per share kind of correlate with net income. We can see in 2021 they had a negative EPS. Since then, it has grown. Trailing 12 months, again, they are lagging by 5.31%. So taking a look at their balance sheet, we can see that total debt has skyrocketed. In 2024, it now sits at $442.04 million. Now, their free cash flow and their cash and equivalents can completely cover this, so there's nothing to worry about. The reason for this increase in the total debt was because they took on this $700 million loan in a credit facility. Credit facility is kind of like a corporate credit card. It's this relationship with multiple different banks, and you take on this big loan. It is multi-currency too, and OnCloud does produce a lot of revenue from the United States, so they need this big loan that is multi-currency. I also think this is fine and quite strategic right now, considering the interest rate is super low, so their borrowing cost is super low. Great time to take out a big loan and start putting money into the company, expanding products, expanding their wholesale partners, also expanding their stores. And finally, their free cash flow looks super strong. Trailing 12 months, they are lagging. Percentage change is down around 20.46%. They still have one more quarter to report earnings, so I'm not too worried, like I said. And now we can kind of see this pattern that we've been seeing with the earnings per share and net income. They kind of had negative free cash flow for a couple years, and in 2023, they had this big increase in free cash flow. 2024, they had this big increase in free cash flow. Trailing 12 months, they are a little behind. But we can see from the big increase in total debt that they may be reinvesting some of their money into the company, expanding products and such, like I said. So there's really nothing to worry about. Free cash flow too, and cash and equivalents, when taking in both of those, can still cover this big debt. And it's still a very strong number, $392.79 million, when comparing it to really the maturity of the company. Taking a look at some of their statistics, first, inventory turnover. This is really the only concerning factor that I have with this company, but a little bit lower than I want to see it, 2.58. Which was a 26.32% increase. So they are kind of increasing it, which is always a good thing, but they do have this big amount of stock. And, it raises questions whether or not, they're going to be able to sell all this inventory. But I think as the company continues to grow, becomes more mature, this inventory turnover ratio should start to increase, and they can kind of turn over a lot of their products and start selling them to the customers. So their operating margin is good. It's average. It's nothing too crazy, though. Their cost of sales is quite low. So I was expecting a higher operating margin, but 9.12 is completely fine. All right, taking a quick look at their valuation, their PE is pretty high, 60.36, a lot higher than their sector median. This would raise a lot of concern, although, their earnings per share are pretty strong, and their forward PE is considerably lower, 29.67. Given the earnings per share growth that I'm going to show you in the future, this number looks great for their forward PE. Their PEG is sitting at 1.46, a little bit higher than I want to see it, but that's okay. And with the forward PE being lower and their future growth and earnings per share, number could come down. Price to sales, 4.60. Price to books, 8.17, a little high there. Price to cash, 12.95. Price to free cash flow, 39.85. So the amount of insiders that own the stock is very high, 31.09%. And we've seen no insiders selling or buying anything. So 0% for insider transactions. Now, their institutional ownership is pretty high, a little bit higher than I want to see it if I really want to see the stock grow. Although I wouldn't really describe this as a value stock. So for growth stock, high institutional ownership is fine, 55.50%. Now, institutional transactions, some institutions are starting to sell it already. There is a high turnover ratio when looking at mutual funds, hedge funds, whoever is really buying it. But nothing too crazy, 4.86%. Now the number you've all been waiting for, because I've been talking about it this whole entire time, but the revenue growth, or just overall growth, but revenue growth forward is sitting at 30.71%. Huge compared to their sector median, which is sitting at 3.24%. Now their earnings per share diluted growth forward, which is important in determining their forward PE, sitting at 61.57%. Helps kind of balance out the valuation. Also shows that the company is extremely profitable. I'm not a financial advisor, so all this investment advice is for educational purposes only. Personally, for me, I'm adding this company to my buy list. The fundamentals are great. The future growth looks tremendous, which will help you have a higher return in the stock price. Tariffs are going to decrease on imports from Switzerland from 39% to 15%. So this makes the company very much more defensive against the tariffs and more profitable. They can reduce the cost. I would consider this as a growth company, as I said in the video. I don't view this as a value company, obviously. Their PE is extremely high. I didn't run a DCF on them, but I'm sure the DCF is probably overvalued, but not just a slow growth company. It does show signs of pretty high growth in the future for the stock price. So for me, the right time to buy the company is right now. Since I made the video on OnCloud about a month ago, I'm still thinking that this is a buy. I think if you wait a month, yeah, maybe it will return positive growth, although I don't think you're going to see too much growth if the analysts are correct. I do think the stock will go up, though, if the analysts are correct or wrong from my own analysis. Another important note is that this is a cyclical company, so the market price of the stock does go in swings. So if the consumer is doing very well, then, the stock price will go up because they're more profitable. If the consumer is doing very bad, then the stock price will decrease. So again, if you guys have not already joined my Discord, definitely make sure to go do so. It's linked down below. It's completely free, offers a lot of tools and insights into the economy, stock market, and the bond market. If you're sick of mainstream finance, pessimistic news, go join my Discord. It's optimistic, and it looks at stocks that could possibly grow in the future, how well the economy is doing, as well as the bond market, like I said. So definitely make sure to go check that out. So thank you for watching this episode of the Weekly Ticker. Drop your opinions down below on OnCloud Holdings. Definitely make sure to go like, subscribe, and I'll catch you in the next episode.